Welcome to the Deep Dive, your shortcut to really getting informed.
We try to cut through the noise for you.
Exactly. And today we're plunging into the latest Starbucks earnings call, that's ticker SBUX, for their Q2 Fiscal Year 2025.
Right. And this past quarter, well, it definitely presented some headline challenges for them.
Yeah, some big ones. But management really tried to paint this picture of strategic transformation. Lots of confidence.
A whole lot of confidence in their, quote, back to Starbucks plan.
That's the one. So we're going to kick things off with a snapshot of those headline numbers.
The big figures, yeah. And then we'll really delve into the operational shifts management's story.
Their strategic narrative, yeah. And what it all means for the company's future and, well, for you.
Okay, let's get straight to those numbers then. Starbucks second quarter, fiscal 25, they dropped after markets closed on April 29th.
And the headline was?
Both GAAP and non-GAAP earnings per share, EPS, came in at 741 cents.
41 cents. And the consensus?
Consensus was around $0.49. So that's a notable miss. 8 cents per share.
Wow, okay. That's roughly, 16% below expectations?
Exactly. A significant miss there, definitely.
Certainly not what investors were hoping for. And it wasn't just EPS, was it?
No, revenue also came in a bit light. $8.76 billion.
Against expectations of?
$8.83 billion consensus. So slightly below. Though, to be fair, it did see a modest increase, about 2% year over year in constant currency.
Okay, so some growth, but still a miss.
Yeah.
What about same-store sales?
Globally, comparable store sales declined by 1%.
Okay.
And specifically in the U.S., we saw a 2% decline in transaction comps. So fewer people coming through the door, essentially.
But the average ticket size was up 3%.
Correct. People spent more when they did come in.
Interesting dynamic.
Yeah.
And the market reaction?
Well, the immediate reaction was pretty sharp. A significant downturn in after-hours trading clearly reflected investor disappointment.
Makes sense.
But interestingly, the stock did claw back some of that in pre-market trading. That was after management gave more detailed commentary on their strategy.
So the narrative maybe softened the blow a bit. Suggests there's more to the story.
Absolutely. There always is. So let's move into our deeper dive. Let's really dissect these figures and what Starbucks leadership is actually doing about them.
Right. That roughly 16% miss on EPS, the slight revenue shortfall.
Yeah.
They definitely caught the market's attention. But it's fascinating, like you said, that management is pushing this narrative, a deliberate transition.
Precisely. That global comp sales decline of 1% is the big picture, but the nuances underneath are, I think, really insightful.
So in the U.S., transactions down 2%, but average ticket up 3%. Customers spending more per visit, maybe fancier drinks, adding food.
Could be. Opting for higher-priced items, adding more to their orders, yeah.
What's also intriguing is management noted an improvement in that transaction decline quarter over quarter.
An improvement in the decline. So still declining, but less steeply.
Exactly. Especially in the morning day part, which is, historically their strongest time. Okay, so if transactions were still down overall, what drove that slight improvement in the morning? And they mentioned choppiness with rewards members. That sounds a bit contradictory.
It does on the surface. Good question. Management explained this was largely due to a deliberate strategic shift. They're moving away from heavily discounted offers.
Pulling back on the deals.
Right. And while this initially caused some choppiness, as they put it, with rewards members, meaning some folks primarily driven by those deals might have pulled back a bit.
Fewer visits from the bargain hunters.
Essentially, yeah. But the company believes it's building a healthier underlying base. They're aiming for more full-price transactions from customers who value the experience, the product, not just chasing discount volume.
So it's a short-term hit to transactions, potentially for what they hope is a more profitable, loyal customer base in the long run.
That's the bet. It's a bold move in a pretty competitive market right now.
No kidding. How did international markets fare? Did they use the same strategy or?
Well, the international picture offers a good contrast. Canada, for instance, showed positive comps and transaction growth.
What drove that?
Largely fueled by strong food innovation, apparently. Their food comparable sales were up an impressive 12.5%.
Wow, 12.5% on food. That really shows the power of diversifying beyond just coffee.
Definitely. And then China, which everyone watches closely, despite all the macro headwinds there, they managed flat comparable sales.
Flat is maybe better than down in that environment.
Right. And they saw positive transactions and improving margins.
How'd they manage that?
It was attributed to their focus on product innovation and, interestingly, value perception. They introduced things like true taste beverages, focusing on core coffee flavors, new sugar-free options.
Setting those health trends.
Exactly, and strategically priced new items to appeal to a broader demographic. And it's worth noting, 8 of their top 10 international markets actually saw flat or positive comps. So resilience outside the U.S.
That tells you their global strategy really needs to be nimble, localized. Okay, let's turn to the consolidated operating margin. That contracted pretty significantly, right, to 8.2%.
Yeah, down 450 basis points from the prior year. That's a sharp drop.
What's behind that?
It is, and it brings up a crucial point. Deleverage. Basically, their fixed costs, like that huge network of stores, are being spread across lower sales volumes.
So when sales per store decline, fixed costs eat up more revenue.
Precisely, it compresses margins. But management was also really explicit that this margin hit was also due to strategic additional labor investments in North America.
Strategic investments.
Yeah.
Meaning they chose to spend more on labor.
Yes. Their view is this investment is critical. It's needed to capture additional demand and transactions for future growth. It's essentially a deliberate choice, sacrifice short-term margin for what they believe is long-term gain.
So consciously choosing to invest in their people, knowing it will hit profitability right now, how confident are they that this will actually pay off, that it'll translate into the transaction growth they need?
Their confidence seems quite high, actually, and they backed it up with specific operational initiatives.
Okay, we should get into those. But first, anything else on the cost side? G&A.
Yeah, worth noting, G&A was down 3%. They said that was mostly lapping prior year proxy and advisory costs, plus some savings from a recent corporate restructuring.
But they also flagged potential future restructuring costs.
They did, yeah. Related to a broader store portfolio evaluation. This is where that long-term thinking really seems to be coming in.
Speaking of stores,
Yeah.
they opened 213 net new ones globally in Q2, mostly US and China. But they're also closing stores, about 90 mobile order-only locations through 2026.
Correct, and that's crucial. It points to a reevaluation of their expansion strategy.
Why target those mobile order-only ones specifically?
Well, while they might seem efficient, perhaps they didn't deliver the full third-place experience, or maybe didn't hit the profitability hurdles, especially if the location wasn't perfect.
Right, location, location, location.
Always. Management emphasized a focus now on reducing new store build costs and improving unit economics. They still see potential to double the U.S. footprint eventually.
Double. Wow.
But, and this is the key part, with the right build at the right cost, it suggests a much more disciplined approach to expansion going forward, prioritizing profitability per store over just the sheer number of locations.
Okay, that sounds like a fundamental shift. Let's talk about management's strategic narrative then. This back to Starbucks idea. CEO Nichols said his initial optimism has turned into confidence. Strong words.
Very strong. He believes it's absolutely the right path for a turnaround. And Kathy Smith, the new CFO, she also expressed confidence. She described seeing a familiar pattern: test, learn, iterate, scale.
So what gives them this confidence despite the current numbers?
It really comes down to a core operational pivot. Management is shifting significant investments away from CapEx-heavy equipment.
Like those fancy cold brew systems they were rolling out. Yeah.
Exactly. Things like the Siren Cold system, the cold press, cold brew machines. Those are specialized, capital-intensive machines. Big upfront investment, specialized installation.
Right.
Those kinds of CapEx outlays are now being paused for general rollout. Instead, the focus is shifting squarely onto labor and process, specifically their Green Apron service model.
The Green Apron service model, I like the name. What does that actually entail? They mentioned pilots dropped wait times by 2 minutes.
Yeah, 2 minutes on average in the cafe pilots, which is huge. Think about that morning rush.
Definitely significant for customer experience.
Yeah.
But what is the model itself?
It's pretty comprehensive. It combines new service standards, optimized partner deployment, so getting the right people in the right places at the right times, streamlined routines for baristas.
Making things easier, faster.
Right, and an order sequencing algorithm that helps partners figure out the most efficient way to prepare multiple drinks. It's about orchestration.
Okay, sounds promising. And they're scaling this.
Big time. Set to scale to over 2,000 U.S. company-operated stores by May, and then more than a third of all U.S. coffee houses, over 3,000 stores by the end of this fiscal year.
That's a massive rollout. What's the risk here, though? If they're shifting from equipment, which is a one-time cost mostly, to labor, which is ongoing.
Yeah.
Is there a chance this labor investment doesn't yield the throughput they expect, or just becomes a drag on costs?
That's the absolute core question for investors, isn't it? Management is clearly betting that well-trained, engaged partners, supported by these optimized processes, are ultimately more efficient and provide a better customer experience than just throwing new machines at the problem.
A human-centric approach to efficiency.
Exactly. And this ties directly into their efforts to reclaim that third place concept. You know, the idea that Starbucks is more than just coffee. It's a place beyond home and work where people connect, relax.
Bringing back the vibe.
Pretty much. Initiatives include bringing back ceramic mugs for here orders, expanding free refill policies, ensuring great seats are actually available, and even encouraging handwritten notes on cups for that personal connection.
Little touches.
Yeah. And reworked store designs are coming too, starting in New York City and Southern California, really designed to enhance that welcoming atmosphere.
So it's not just nostalgia. It's a strategic move to differentiate themselves from the purely mobile order, grab-and-go competitors, right? Justify maybe higher prices, encourage people to stay longer.
Which often leads to buying another drink or a snack.
Exactly.
Make the physical store a destination again.
Makes sense. What about product and menu innovation? Is that still a key driver in this plan?
Absolutely. But the focus seems to be shifting slightly. They talked about platform innovation and big movers rather than just adding lots of slow movers that maybe clutter the menu and operation.
Quality over quantity.
Kind of. A hugely successful example they gave was removing sugar from their standard matcha latte powder.
Oh, yeah. How did that go?
Sales increased nearly 40%.
40%. Just from removing sugar.
Yeah, apparently. It shows that sometimes simplifying and improving existing popular products can have a bigger impact than launching something entirely new and complex.
Interesting lesson.
Yeah.
What else is new on the menu front?
They're launching new offerings. Protein cold foam, tapping into that wellness trend, coconut water-based beverages, a new dark roast coffee, upgrades to baked goods, even gluten-free energy options.
Covering a lot of bases.
And they're exploring an aperitivo menu for the afternoons. Things like sparkling beverages, sippable coffees, snackable bites, trying to capture that slower afternoon day part.
Trying to get people in after the morning rush.
Yeah, and moving towards a more regular cadence of limited-time flavor launches. Plus, digital menu boards are rolling out to over 25% of U.S. stores, which lets them tailor marketing messages for different times of day.
Dynamic menus. Okay, this all sounds like a big push on the in-store experience and catering to changing tastes. Crucially, this relies on the partners, the baristas. How are they ensuring those partners are engaged and sticking around? High turnover kills consistency.
Totally. And this is actually a major bright spot they highlighted. The Shift Marketplace update, that's their internal app for swapping shifts, has apparently increased the pool for last-minute shift changes by 10 times.
10 times. Wow. So easier for partners to manage their schedules.
Seems like it. And it's led to record high shift completion rates and, get this, the lowest turnover on record, under 50%.
Under 50% turnover in food service. That's really low.
It is. And that directly translates to more capable, more experienced, more consistent partners behind the counter, which in turn should mean a much better, smoother customer experience.
Happy partners, happy customers. Makes sense. And it sounds like their marketing efforts are also clicking.
They presented data suggesting they are. New U.S. brand campaigns apparently generated record-breaking customer engagement. They even had their second highest Monday gross sales day ever off the back of one.
Huh. And customer perception.
Starbucks' first choice ranking among customers is apparently the highest it's been in 2 years. And their TikTok engagement is up nearly threefold. So the message seems to be resonating, at least based on those metrics.
Okay, let's talk pricing. Always a hot topic.
Yeah.
Management stated pretty clearly their intention not to increase prices for the rest of fiscal 2025.
Yeah, that was a clear statement. They see pricing as the last lever.
So focusing on value enhancement instead, like not charging extra for some dairy alternative.
Exactly. But is that realistic in this inflationary environment? How do they plan to offset rising costs if they're not raising prices?
Good question.
The new CFO, Cappy Smith, she emphasized a focus on zero-based budgeting.
Zero-based budgeting. Can you unpack that quickly?
Sure. Instead of just adjusting last year's budget up or down, every department has to justify every single expense from scratch, every year. It forces a much leaner, more intentional allocation of resources. Find the savings before you think about price hikes.
Ah, okay. Intense, but potentially effective.
And interestingly, they noted coffee costs themselves remain a relatively small portion, maybe 10–15% of their overall product and distribution costs. And they manage that through sourcing and hedging anyway.
So coffee bean prices aren't the biggest driver of their costs.
Apparently not the dominant one, no.
Okay, that makes sense. Finally, let's look at the guidance and outlook. The new CFO, she declined to issue specific numeric guidance for the full fiscal year.
Correct. She cited needing time to get acclimated to the business and also the current dynamic market conditions.
What does that lack of specific guidance signal to you or to investors generally?
Well, it signals a few things, I think. First, probably just prudence from the new CFO, taking time to fully understand the business before putting hard numbers out there.
Makes sense.
Second, it acknowledges the current market volatility and maybe the difficulty in forecasting the exact impact and timing of these big strategic pivots they're making.
Hard to predict when the turnaround takes hold.
Exactly. However, she did note an expectation for a Q3 U.S. top line to follow normal seasonal trends. So, some indication there.
Okay, but the main emphasis is?
The emphasis is squarely on discipline, making sure these investments yield the expected outcomes in tests before they scale them widely. It's all in service of, quote, long-term durable growth and strong returns on invested capital, or ROIC.
Got it. Disciplined long-term growth, ROIC. Anything on supply chain risks, tariffs?
Yeah. They mentioned they're actively managing tariff risks by diversifying supply chains, shifting production where possible. Standard playbook stuff, but important.
Okay, so let's try and synthesize this. What does this all mean for you as an investor or just someone watching a major consumer brand navigate some choppy waters? This earnings call, it really highlights a critical strategic pivot for Starbucks, doesn't it?
It absolutely does. They are, in essence, sacrificing near-term financial performance, especially on EPS and margins, to make these significant investments in what they believe will be the foundation for long-term profitable growth.
That's your trade-off.
A very deliberate one. And that shift from CapEx-heavy equipment to OpEx-heavy labor, that's a noteworthy change in their whole capital allocation philosophy, their operational approach.
Re-emphasizing the human element, the third place idea.
Which management clearly believes is core to the brand's heritage and, crucially, its future differentiation. And those improvements they cited in partner engagement and retention, those are potentially strong leading indicators.
If partners are happier, stay longer, service improves.
It directly impacts service quality, throughput, which should eventually translate into better customer satisfaction and, the hope is, transaction growth.
And that portfolio review.
Yeah.
Closing stores, focusing on build costs.
Yeah.
Even if it slows near-term unit growth, it's clearly aimed at improving overall store profitability, making sure future growth is smarter growth.
A more disciplined approach to expansion, for sure. And you saw the divergence in the market reaction, right? Initial dip on the numbers, and then some recovery on the strategic narrative.
Yeah, that shows the debate.
Exactly. Is this turnaround plan truly credible? Will the long-term payoff actually materialize? Or are these near-term misses a sign of deeper issues? The tough consumer environment, intense competition.
And management is clearly betting hard on the turnaround story.
They are. They're asking investors to look beyond the current EPS, to see this as a necessary investment phase. But, the fair question remains, what if this pivot isn't enough? Or what if it just takes much longer than anticipated to show results on the bottom line?
That's the inherent risk in any big strategic shift like this.
Always.
All right, it is time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on today's deep dive.
Let's hear it.
Okay, so despite Starbucks' Q2 EPS miss, despite the lack of specific guidance, management has laid out a very clear, if maybe painful in the short term, strategic roadmap. They're explicitly telling us, look beyond current EPS, focus on the operational momentum we're building.
Right. Focus on the turnaround story, not the last quarter's numbers.
So here's the pitch. Consider a long position in Starbucks, SBUX, maybe via longer dated, slightly out of money call options.
Okay. Longer dated calls. So giving the strategy time to work.
Exactly. Now, the outrageous part, betting bullish on a company that just missed earnings pretty badly and pulled its specific guidance. That definitely seems counterintuitive.
Yeah, the market's initial reaction tells you it's not the obvious play right now. It requires believing in a turnaround that isn't showing up in the financials yet.
It's a bet on potential, absolutely, not current performance.
Okay, so what makes it plausible?
Well, the argument is the market might be underpricing the potential long-term impact of two key strategic shifts we've discussed. First, that capital allocation pivot.
Moving from CapEx to OpEx, the green apron model.
Right. Moving away from expensive equipment rollouts towards investing in labor, training, processes via things like the green apron service model. This isn't just about saving upfront cash. It's a strategic bet that this approach unlocks more efficient operations in the long run.
Better customer experience through people.
Exactly. Which could lead to a more favorable return on invested capital as this model scales across thousands of stores. Plus, they're actively managing costs with that zero-based budgeting and optimizing the portfolio, getting rid of underperforming assets like those mobile-only stores. It's a fundamental change in how they deploy capital.
Okay, that's point one. What's the second?
The second is the third place reassertion. In this kind of uncertain economic environment, consumers often still look for affordable luxuries, experiences, a sense of community.
Comfortable in the familiar.
Precisely. Starbucks is doubling down on restoring its heritage as that community hub, a place people want to spend time, not just grab coffee and run. Those initiatives like ceramic mugs, better seating, they aren't just cosmetic.
They're designed to drive loyalty, encourage longer visits.
Which often means incremental purchases, right?
Yeah.
And it helps justify their premium positioning. As macro headwinds maybe ease, or even if people just continue to seek comfort, that third place could be a real draw.
So the trade idea is basically a bet that these operational improvements, this strategic recalibration, they will eventually yield tangible financial results.
In the coming quarters, yeah. Leading to a potential re-rating of the stock as the back to Starbucks turnaround story gains traction. Even though there's financial pain right now, it's playing the long game on this foundational shift.
Got it. An outrageous but perhaps plausible scenario.
So to wrap up our deep dive into Starbucks' Q2 FY25 earnings call. Look, the headline numbers for the quarter were undeniably disappointing. No way around that.
Yeah, the miss was clear. But management did present a compelling narrative, didn't they? A story of a business in the midst of a very disciplined turnaround effort.
That back to Starbucks strategy, it really is all about recentering on the customer and empowering those partners. With that significant pivot, as we discussed, to labor investment over big capital expenditures.
They're making foundational changes, aiming to improve efficiency, enhance the in-store experience, even if it means taking that hit on margins in the short term.
The path forward, as they laid it out, is one of strategic investment, optimizing that store portfolio, continuing innovation, all aimed at long-term profitable growth.
It's a story of patience, discipline, and ultimately execution. That's what it'll come down to.
Absolutely. So as you, our listener, reflect on this turnaround story, what stands out for you as the most critical piece? Is it that deliberate focus on labor, the strategic shift in the store portfolio, that renewed emphasis on the third place, or maybe how they're approaching innovation now? What do you think truly defines this moment for Starbucks?
Lots to think about there.
Indeed. Thank you for tuning into The Deep Dive. Remember, the information discussed today is for informational purposes only. It is definitely not financial advice.
Please, do your own research. Consult with a qualified financial professional before making any investment decisions.
Until next time, keep digging for those insights.